I came across this article yesterday that holding cash may mean risky business. And the whole gist of the idea of this article is to get you invested. But if you ask anybody in Singapore, they'll definitely say that properties deliver much more wealth than stocks, simply because there's more stories of windfalls than someone who is invested in stocks. And the main thing about this article, it shares that investors are actually holding cash, they are waiting for the right moment. And there can be two kinds of people. The first is actually someone who is not savvy. Someone who is not savvy is holding too much cash, a typical person like this looks for guaranteed fixed deposit, and it's hard to change this kind of a person, and there's nothing wrong with that. But the more problematic one is the second type of person, which is not savvy and yet trying to time the market. This person sells out from his investments at any point of bad news. This person sells out from all his stock holdings whenever there's a slight dip. But this person is the one that buys in everything whenever a stock market goes up and there's rosy news. This non-savvy investor is going to really suffer a lot when it comes to investing in financial markets. But the other kind of savvy investors are holding cash. They are doing it the right way. How it's being done is when markets go up, they actually hold back on purchases or even sell out slight portions, but the bulk of it remains invested. They are not afraid of paper losses. They are not afraid of looking at near-term downward trends. So that is a main difference of why a savvy investor holds cash versus a not savvy investor when it comes to holding cash. The results are a world of difference. And the next part of this article actually shows this part, which is equities outperform stocks in the long run. And again beats the question why most in Singapore will definitely prefer properties over stocks. But I have this chart to explain to you exactly why people have this mindset. Look at this chart over here. You realize that when it comes to investing in stocks for 20 years, you are almost certain of getting a gain. When it comes to investing of period of 10 years, the possibility of getting gain is supremely high. But look at this closely. When it comes to investing for 5 years, it does not make much of a difference between 5 years and 1 year. You are almost half certain to make a loss. And this is very important because when it comes to thinking about your investing time frame, when it comes to stocks, most people would say a few years and they think it's long. But in actual fact, up to 5 years, there's not much of a difference when it comes to investing results. The time frame must be 10 years, the time frame must be 20 years. And that is why when most people buy properties, they buy as homes. They are quite comfortable staying for 10 years or even 20 years, and without looking too much, that thing actually delivers a return and a windfall to that person. So this is the quick tip for today. When it comes to investing, stocks can outperform only when you are having a right time frame. Only when you're looking for 10 years or 20 years. With that in mind, you can be a much more successful investor. This is a quick tip for today. I'll sign off from here. Take care and goodbye.